We're going to calculate the stock price for Chef's Warehouse using prior financial information. First, we need the market cap, and that's 551.28 million. And the stock price is $14.94. So if you take the market cap divided by the stock price, you get the shares outstanding of 37 million. Next, we need the free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and then discount that number back to today's dollars. And that's what we're doing in this video right now. So the free cash flow is in Yahoo Finance, which is cash flow from operations minus CapEx. We also need net income, which is an income statement. That's profit and loss for a given year. We need 4 years for this model. And the last is revenue, the sales. And it looks like they have a steady increase in all their numbers each year. So that's a good sign for an investor. Oops. Now we need to look at the capital structure of Chef and figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on a debt of 18 million. And we need to figure out their debt. So we'll go to the balance sheet and then the current liabilities. So current debt of 721 million, which is the debt due within 1 year. And long-term debt due after 1 year, is 386 million. So they pay 4.7% on their debt. Interest payments are tax deductible, so let's figure out their effective tax rate also. So we'll go back to the income statement. We'll get the income before tax, 32 million, and the income tax of 8 million. And the effective tax rate is 25%. So the cost of debt is 3.5%. And it's fairly leveraged. 41% of the capital structure is debt. So that's not the best sign, but let's move on. We'll figure out the cost of equity, and we need the beta for that. The beta is the volatility of the stock, and they have a fairly high beta at 1.97%, so it moves twice as much as the market. And we use the capital asset pricing model to figure out the beta, and it says that the cost of equity is 17.45%. So equity, as you can tell, is more expensive than debt, a lot more expensive, because equity sits lower in the capital structure of a company, and that's why it's more risky. In the event of a default, debt holders are paid before equity holders. And this calculation, 11.71%, this is a blend of the debt and equity. And 11.71% is the price Chef pays to obtain financing. So Chef needs to generate at least this percentage in profit a year to add value to its investors. And if it does not year after year, it will eventually go bankrupt. But that's the WACC, and that's what we're going to discount the future cash flows by. And we estimated the future cash flows for 4 years. And we also have a terminal value, which is all the years after year 4 of free cash flow. And we used a Gordon growth model to figure that out. And we discount those numbers back to today. And the value of Chef is 360 million. And when you divide it by 37 million shares, we get a stock price of $9.76. So according to the model, it's a sell because it's trading at a 53% premium. It's trading at $15 a stock, and we calculate the value at $10. So you can see it was trading at a really extreme premium a few months ago in the 30s. It's come back down to reality. But stocks can trade higher or lower than intrinsic value because the stock price is predicated on supply and demand of the market. If more people want to buy the stock, the price goes up. If more people want to sell the stock, the price goes down. And if you do your research, you always find some analysts say buy this stock, and other analysts say of the same stock to sell that stock. So there's always differing opinions, but each analyst uses their own model and their own unique assumptions. But you never actually see the model. This is my model, in my opinion. So I hope you liked the video, and thanks for watching.